This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. We're going to have a look at question 1 from the December 2014 paper P4 exam, which is a particularly good question because, well, for two reasons. One, because of just the style of the question, the way to approach it, which is the same sort of approach, the same sort of style, whatever topic's asked. And secondly, because although it's actually quite a difficult question, because of the volume, the number of things that you're expected to do, within it, it's testing lots and lots of different things that you should have already covered as you've been working through the syllabus. You'll see as we go through, it's got bits of gearing and ungearing betas, it's got calculating weighted average cost of capital, all things that you should be happy with, and individually, most of them are reasonably straightforward, but it's just there is so much to do in the time. I think that's really what makes it a hard question. Just two things before I make a start. One is I will break this lecture up into parts. I mean, there's a 50-mark question, it's a long question, and so we will break this into a few little bits so that you've time to think about it. And secondly, there are several written parts to the question. I'm not going to write the written sections out in full, the answers. I think that could just be too boring. You've got the printed answer from the examiner. I will talk through what he was after, but again, to write it out in full I think is a bit unnecessary. Read his answers later and check they agree with what you thought I said. And remember, he always writes more than he expects you to actually write in the exam. Anyway, let's make a start. First of all, as I would in the exam, before reading the body of the question, look straight at the requirements. Part A, discuss whether or not Nahara's acquisition strategies of pursuing risk diversification and of purchasing undervalued companies can be valid. Obviously, we'll read the information and deal with it shortly, but 7 marks, and that's entirely written fairly clearly. And note he is actually asking two things. Discuss the strategy of pursuing risk diversification, that's one thing, and purchasing undervalued companies. Anyway, we'll come back to that in a minute. Part B, excuse me, again entirely written, discuss why the European Union may be concerned about their stated intention and how selling Fugi could reduce the concern. Doesn't mean much for the moment, but 4 marks. He's not expecting much, but anyway, it's entirely written. Part C, prepare a report, which is so standard in the compulsory question in P4. But here's where the calculations come. Estimate additional value of luxury transport, evaluate the benefit. Well, there we are. So, let's make a start. A, discuss whether or not their acquisition strategies can be valid. And look at the body of the question and look how generous the examiner's been. And this is very standard, it's not unique to this question. You'll see there are several bold headings. First one, Nahara and Fugi Company. Second one, Avon Company's acquisition interest in Fugi. And the third one, further down the first page, proposed luxury transport investment project. Well, let's start at the top. Remember, we're looking at their acquisition strategies. It asks you to discuss them. Nahara is a private holding company owned by the government of a wealthy oil-rich country to invest its sovereign funds. Nahara has followed a strategy of risk diversification for a number of years by acquiring companies from around the world in many different sectors. Well, that one paragraph is telling us all we need for the very first bit of Part A. It says, discuss whether or not their strategy of pursuing risk diversification can be valid. Well, this is very standard portfolio theory stuff that you should know, that the idea of diversifying risk by investing in a portfolio, investing in several different companies, that what we're doing is eliminating or reducing the unsystematic risk. And without having a full lecture on portfolio theory, the more companies you invest in, the more we're able to reduce and ultimately, hopefully, remove the unsystematic risk. And that's the benefit of diversifying. Once we are well diversified, it can't be reduced anymore. And from then on, it's simply the systematic risk that matters. We can't reduce risk any further. The systematic risk determines the return that we'll require. And so I'm talking a bit much here for only part of 7 marks, but what he was after is that we reduce unsystematic risk by diversifying. I said I won't write in full, and I'm not going to. If I can spell. By diversifying. However, once we're well diversified, it's no longer relevant. Once we are well diversified, when we've got a large portfolio, standardly 18, 20 investments, when we're well diversified, we cannot reduce risk further. So that's essentially what it is really all he was after. In this particular one, it says they followed a strategy for a number of years, and so certainly it's been a sensible strategy. I'll keep writing here, but it's been a sensible strategy. As far as Fug is concerned, I'm jumping ahead here, but they are thinking of acquiring Fugi. But as far as acquiring more companies is concerned, if they are already well diversified, then it's not a question of diversifying anymore. They're not going to reduce risk anymore. But there we are. That really is all he was after for the first bit of it. The second bit, though, what about their strategy of purchasing undervalued companies? Well, look at the second paragraph of the question. One of Nahara Company's acquisition strategies is to identify and purchase undervalued companies in the airline industry. And a recent acquisition was Fugi, a company based in a country which is part of the European Union. What about that strategy, purchasing undervalued companies? Now, on the face of it, that's very sensible. If Nahara sees a company valued at 100 or something, and they realise that it's actually worth more, that it's currently undervalued, then obviously it's sensible to invest and make a profit out of it. But what he's really after is, how can that happen? The only way, it's the investors are the people who have placed the value on the business. The only way that Nahara can find a business that's undervalued and realise it's undervalued is if they've got better knowledge. What I'm getting at is this. Just suppose current investors are expecting, let's say, growth at 5%. They'll have valued the business on the basis that they expect it to grow at 5%. But suppose Nahara has more information and they realise that, it's going to grow at 10%. Well, of course, if it's going to grow at 10%, it's worth more. But again, if the current investors are only expecting 5% because they don't have the same information, then currently its value will be lower, it will be undervalued. So this strategy, it's only going to work, it's only valid if, for some reason, Nahara has better information than other investors. Now, in a perfect world, that can't happen. In a perfect world, all investors, including Nahara, they all have the same information. It wouldn't be possible for it to be undervalued. But if for some reason Nahara has access to better information, then and only then could they end up making a profit out of it. So there we are, part A. I've talked a bit too much, but 7 marks. Obviously, write it a little bit nicer than what I've done, but do appreciate he was asking for 2 separate things. Risk diversification, purchase of undervalued. And so make sure you have written a line or 2 about each. You know, and leave a space between so that they can mark each of the 2 bits. And also note that we've only needed the first 2 paragraphs. I mean, that's why he headed it up. He was helping you. Those other 2 headings, there's lots and lots of information, which we're going to need later, but for the moment, it's not relevant. Why waste time reading it and getting worried? Let's get the marks as we come to them. Let's move on to part B, which again is written, I said earlier, it's only 4 marks, so we don't want to waste too much time on it. But discuss why the European Union may be concerned about Nahara's intention and how selling Fugi could reduce the concern. Again, 2 things, you'll see in a minute they are interrelated, but why might they be concerned? And how selling could maybe reduce the concern. Well, look back at that first section again. We've just read a moment ago the second paragraph. It said a recent acquisition was Fugi, a company based in a country which is part of the European Union, and they repair and maintain aircraft engines. It carries on. A few weeks ago, Nahara stated its intention to pursue the acquisition of an airline company based in the same country. That's Fugi. The EU, concerned about this, asked Nahara to sell Fugi before pursuing any further acquisitions in the airline industry. Well, he's effectively told us the answer, surely. They owned Fugi. It's a company that's involved in aircraft. They repair and maintain aircraft engines. There aren't that many companies, because of the size of the business, there aren't that many companies involved in aircraft. And they're now thinking, in the 3rd paragraph, of buying another airline business, an airline company. Why should the European Union be concerned? Surely the concern is because of the danger of it becoming a monopoly. As simple as that. That's why they're concerned that 2 companies in the same industry, in the same country, there's the danger of it being a monopoly. The second bit of it, how selling Fugi could reduce the concern. Well, if they do feel there's a danger of monopoly, surely they won't want them to own 2 companies. They got the choice. They would either not allow them to go ahead and buy this other airline company, or if they do go ahead and buy it, insist that they sell Fugi. So again, I'm not going to write that, I don't need, but they're interrelated. I really do think that was a very obvious 4 marks. It's not always easy to get full marks on a written, but 4 marks there should be no problem. But yet again, it is 2 things he was asking, even though they are related. Make sure you made 2 separate points. Before I go any further, just think for a minute. We've done part A and B, and we should have been able to get most, if not all, of those 11 marks. And so far, only that first bit of the question's been relevant. You know, whether what's coming is easy or hard, for the moment, I'm not interested. There's 11 marks there. Shortly we'll go on with part C, which wants a report, and that's where all our calculations will be needed. But as always, it says at the bottom, professional marks will be awarded in part C for the format, structure and presentation of the report. Now, the reason that's so important is that whatever arithmetic we're going to be able to do or not do, however hard or easy Part C is, there's 4 marks there we can get doing no numbers at all. I'm not going to write a full report here, it'd be silly. You can look at the exam, I'll do the numbers, but you can look at the examiner's answer later and read his report. But in terms of format, structure and presentation, to get the marks, look at his style afterwards, but head up a sheet, report, write who it's to. It says prepare a report to the Board of Directors, so report to Board of Directors. Have an opening paragraph. We've been asked to estimate the additional value, whatever. Don't need to know what they mean here, we're effectively copying the question. But have a little introductory paragraph. And then, not yet, but certainly when the time's running out, make sure you've written a concluding paragraph. We recommend. Finally, although we'll fill in bits of the report as we do the question, but having set up who it's to, the opening paragraph, open another sheet headed up appendix, and it's the appendix while we'll do the workings. And if you've done that, if you've got one sheet, started off the report, opening paragraph, if you've got another sheet headed up appendix, then you're going to be getting those 4 marks, whatever numbers we manage to get out, or even if we're forced to stop. And the reason I'm going on there is, think about this. Part A and B, there were 11 marks, and I've said we should be able to get most of those 11. If you do what I say on the report, there's another 4, that's 15 marks. It's a 50-mark question, and on every question you should be aiming to get 50% of the marks. If we can get 50% throughout, we've passed. So we've got to make sure we can get 25 marks here. From then on, it's almost a bonus. The more extra, the better. But we've got to make sure we can get 25. And if you've done Part A, Part B, and you've done what I said on the report, we've hopefully there got 15 marks. We need another 10, but we only need another 10. And Part C in total, 10, 18, there's 35 marks of Part C. To get all of Part C done and correct is going to be almost impossible. There's a lot of time pressure, you're going to forget things. Even if you remember them, you're going to make mistakes. But if we can get 10 marks out of those 35, which we certainly should be able to do, again, with passing the question, anything extra is a bonus. But you've got to get those 15, and you should be able to get those 15 reasonably quickly. Again, provided you haven't spent half an hour reading all the rest of the information, which so far hasn't been relevant. And all it would have done would have confused. It just wasn't necessary for A, B, and the professional marks on the report. Now let's turn to Part C, where the real work starts. Prepare a report for the Board of Directors. Well, I've said enough about actually setting up the report. And I've said I'm not going to write out the report, excuse me, but do have a separate sheet headed up appendix, and do all your workings in the appendix, and where relevant you can go back and just add things in the report, particularly incidentally the main body of the report. I said there'll be an introduction, ultimately a conclusion, but it's in the report where you'll state any assumptions that we find we need to make as we're going through the arithmetic. Anyway, let's have a go. Part 1, estimate the additional value created for AVEM if it acquires Fugi without considering the luxury transport project. Now again, the examiner has helped you, and it's not uncommon. The styles are generally very much like this. But in that I did say before, he's got 3 bold headings in the body of the question, We've done with the first heading, Nahara and Fugi. The information there was relevant to parts A and B. We've then got a heading, Avemco's acquisition interest in Fugi. And remember, we're about to look at additional value created for Avem if we acquire Fugi. There's a third heading, proposed luxury transport investment project by Fugi. Well, part C1 specifically says, without considering the luxury transport project. And so for the moment, that third heading and everything that follows is irrelevant. All we're interested in, all the information we need, is under the second bold heading on the first page of the question. And so again, don't read ahead and start worrying yourself. Let's concentrate on what we're asked for. Additional value for acquired Fugi. Well, let's have a look. That second heading, it says Avem, a UK-based company specialised in producing and servicing business jets, has approached Nahara with a proposal to acquire Fugi for 1,200 million. So Avem's going to buy Fugi from Nahara. Nahara expect to receive a premium of at least 30% on the estimated equity value of Fugi. We give extracts from the most recent statements of financial position of the two companies. And then below, I'll read the detail as we need it, but we told the value of Avem shares, there's some information about synergy, free cash flows to equity, whatever. Well, these two companies are effectively going to merge. Avem's taking over Fugi. Why should there be, what does it mean by additional value? If two companies, we'll check what they're worth in a minute, but I mean, suppose one's worth 200 and one's worth 100. In total, they are worth 300. Why, if they actually join together, should there be any additional value? Well, it's because of things like synergy. And so surely, to determine what additional value there is, if it becomes one big company, we need to look at how much they're worth at the moment. And then we'll look at what they'll be worth if they come together. And the difference between the two will be this additional value that we're looking for. So let's make a start. Let's first of all work out what the values of the two companies are currently. Label your workings. Workings 1, so you can cross-reference later if we need. And always say what you're doing. I mean, I'm going to work out the current values of Avem and Fugi and do add them up. The reason being, different people might do the question in a different order. That's not a problem. But it's no good just having loads and loads of workings, especially given that you might well make mistakes, and expect the marker to sort out what it is you're trying to do. You know, it's obvious here what I'm trying to do. And even if I get it wrong, provided I'm approaching it the right way, I'm still going to get marks. But it's only going to work if the examiner knows what it is you're trying to do. Anyway, I'm trying to do current values of Avem and Fugi. So what are they currently? First of all, Avem. Well, that's nice and easy, surely, because we're told what the value of the shares is. Immediately below those extracts from the statements, each Avem company share is currently trading at $7.50. Well, if we know the value of the shares, the total value of the equity, the same financial position, the share capital is 800 million. I'm not going to keep writing millions down. I'll do everything in millions, but it's 800 million. But that's the share capital. But do note, they're 50-cent shares. And so how many shares are there? Surely there must be 1,600 shares at 50 cents. So there are 1,600 shares. Each share is currently trading at $7.50. And therefore the total value of A then, 12,000. So that bit of it's easy enough, and each bit will get me a mark, whether I manage to finish it and get it right or not. What about the value at the moment of Fugi? Well, I know what the share capital is, again, from the statement, but Fugi. The second paragraph below the statement, they've not given us the share price. They've told us the free cash flow to equity is 76.5 and is expected to generate a return on equity of 11%. Well, I need the value of the equity. Again, had we been given a share price, it would have been easy like A then. Since we're not, we're going to have to calculate the value. And surely the value of the equity, fairly standard from other parts of the syllabus, we'll take the free cash flow to equity and discount at the return of 11%. However, now this has happened in some questions, had they given us the free cash flow to equity is 100 in 1 year, 200 in 2 years, 250 in 3 years and so on, then it would have been straight discounting, discount the free cash flows at the return of 11%. Here, we're told the current cash flow is 76.5, but all we're told about the future, though, is look at the last line of that paragraph. Over the past few years, Fugi has returned 77.3% of its annual free cash flow back to Nahara. They've retained the balance for new investments. Well, you should remember from elsewhere that if they're retaining, that should give rise to growth. And so what we've got here is a free cash flow currently 76.5, but we will be expecting it to grow at 2%, 3%, 4%. We're going to have to check in a minute. And so, if ever you've got a growing free cash flow, effectively, we'll use the dividend valuation formula. To get the value of Fugi, I'll leave a space because I want to, fill it in later. But to get the value of Fugi, you've got on the formula sheet that the market value is the dividend times 1 plus G over RE minus G. And it's going to be exactly the same. Then instead of just using dividends, we're going to use free cash flows. But sticking with the free cash flow in that formula will give us the value of the equity. And so what are the figures? Well, D, no problem. The current free cash flow is 76.5. RE, the return, they tell us is 11%, not 0.11. What about G, though? What growth rate do we expect? Well, I've already said we are going to expect there to be growth because, excuse me, the company is retaining. So it's the RB model. The growth, well, the return, 11%, times B, the proportion retained. Well, if they're returning 77.3% and retaining the balance, the proportion retained must be, I should be able to do it in my head, but I won't risk it, 100 minus 77.3, 22.7. Which gives me a growth rate of 2.497%. Or 0.02497, or as near as, damn it, 2.5%. And so now we can work out the market value. Free cash flow now 76.5 times 1 plus the growth rate. Well, I'm not going to mess around. It's almost 2.5%, so 1.025 over RE 0.11 minus 0.025. gives us a market value of £922.5. So there is the current market value of Fugi. And actually, to be safe, I'll do my workings again. That was workings 2. So again, it's clear to the market what I'm doing. But therefore, the current market value of the two is in total 12,922.5. Now, why have I done that? I said earlier, when we started this, if I know how much they're worth currently in total, if we can work out how much they'll be worth if they combine Avon's buying Fugi, any extra is this gain that we're talking about, the additional value. So there's the current values. Let's work out the new market value of Avon plus Fugi. And how are we going to do that? I already noticed there was some mention of synergy. But let's read again those paragraphs beneath the statements of financial position. Each Avon company share is currently trading at £7.50, which is a multiple of 7.2 times its free cash flow to equity. Avon expects the total free cash flows to equity of the combined company will increase by 40 million due to synergy. And after adding the benefits, the multiple of the total free cash flow of the combined company is to increase to 7.5. Now think about that carefully, because it's effectively telling us what to do. You see, the current market value of Avon is 7.2 times its free cash flow. The last sentence of that paragraph tells us the combined company, the multiple, the total market value will be 7.5 times the free cash flow. So what we're going to have to do, if we can work out the free cash flow of the combined company, market value then will be easy. We'll just multiply by 7.5. So let's see if we can get the free cash flows to equity of the combined company. First of all, Avon. Well, the share price, the value of the shares is 7.2 times the free cash flow to equity. Well, we already know that in total, the market value of the shares, there were 1,600 shares, there's 750 each, it was 12,000. That's 7.2 times the free cash flow to equity. So if I divide by 7.2, what does that come to? $1,666.7. If you round it fine, you don't lose marks for bits of rounding. But there's the free cash flows to equity of Avon. If they're combined, then in addition, we've got the free cash flows of Fugi. And we told them the free cash flow to equity of Fugi is 76.5 million. And finally, synergy. Where are we? Second line of the paragraph beneath the statement. They expect the free cash flows to equity of the combined company will increase by 40 million due to synergy benefits. So an extra 40. And so the total free cash flow, if they combine, £1,783.2. So I think now we're there, are we not? We know what the market values are at the moment, in total 12,922.5. I'm sorry, no, we're not there. I missed out a step. That's the free cash flow to equity. So the new market value in total, it says we expect the multiple of the free cash flows to increase to 7.5. So it'll be 7.5 times the free cash flow, which is there we go, 13374. And now we're almost there. I can carry on with what I was starting to say. If they stay as they are, then between them they're worth 1292.5. When they combined, the value becomes 13,374. And so the additional value, I will label it. Are we up to workings? No, workings 4. The additional value created it's simply the difference. 13,374 minus, what was it, 12,922.5? Gives us 451.5. So there we have our additional value. Not quite there, but we've got virtually all of it. It does say the additional value created for AVEM. Well, although in total there is 451.5 additional value by merging them, it does say, the paragraph above those statements of financial position, that Nahara expects to receive a premium. So you see at the moment, Fugi is worth 922.5. However, Nahara expects to receive a premium on that, so some of that additional value created is effectively having to go to Nahara. So Nahara will get how much? They want at least 30%. Well, if we assume for the moment that we are able to negotiate and it is only 30%, they want to get a premium of 30%. The current value was 922.5. Which I get to be 276.75. And it means that only the remainder of it is left for AVEM. So the premium to AVEM, 451.5 minus 276.25. 175.25 million. And there we are. Something I did say earlier, in the body of the report, excuse me, you will mention that's ultimately going to be part of our conclusions, but also state your assumptions. So you've headed up what we're trying to do, and then you'll say, in the course of our calculations, we've assumed, well, there's one immediately, we've assumed that we are able to buy Nahara, to buy Fugi, and only pay Nahara 30% premium. If when we're negotiating, Nahara ends up insisting on more, then I think, well, if you've understood me, then very obviously the more premium Nahara gets, the less the actual benefit to AVEM is going to be. But there we are, 10 marks. I said earlier there's a lot to do. I think the problem there, I hope you'd agree, is not so much the arithmetic, as it takes a while, obviously, reading it and to understand what's going on. But if you set out each step, you know, there are within that some very, very easy marks. I mean, there may only be one mark, but the current value of A of M, you know, there are several little easy ones. And if you get stuck, you get stuck. You know, move on to the second bit, which you'll see is completely, or virtually completely separate. But anyway, if you have managed to do that, then look, A, B, 11. If we've managed to do C part 1, we're up to 21. If you've set out what I did about the report for 25, it may be wishful thinking, but if you've managed to get part C1 right, we've just about passed that question. And anything we manage to do on the rest of part C is almost bonus marks. The more we do, the better, but at least if we've got that far, we'd have passed it.